Welcome, guys. Welcome. Welcome to another beautiful day. And today I'll be discussing understanding multi-time frame market structure. I believe you all have heard about this topic, and I know this topic is very crucial, and believe me, it can be confusing at times. But today I'm here to break everything down so that you can understand this concept fully once and for all. And mind you, we will be treating this topic using synthetic indices. I'm a synthetic indices trader, so let's get to business. So the first thing we'll be discussing is what is multi-time frame market structure? Multi-time frame market structure just simply means analyzing multiple time frames. So what do I mean by analyzing multiple time frames? To analyze multiple time frames, you just need to go to the respective charts, be it daily, be it 4 hour, 1 hour, 15 minutes, or the minute time frame, and analyze the chart. But it's not as easy as I just made it sound, because you now have to analyze multiple time frame charts together as a unit. You have to analyze everything. You have to break everything into smaller pieces from the higher time frame down to the lower time frame. So we are going to quickly talk about time. What is time? In the Forex space or in the synthetic indices space, time is power. It's very, very crucial. The monthly time frame is greater than the weekly time frame. The weekly time frame is greater than the daily time frame. The daily is greater than the 4 hour. The 4 hour is greater than the 1 hour, and the 1 hour is greater than the 15 minutes. And the 15 minutes also greater than the M5, and the M5 is greater than the 1 minute time frame chart. So that is all you need to know. So wherever you're analyzing from, if you're analyzing from the 4 hour chart as a day trader, then you know that is your higher time frame. But if you're a swing trader, your higher time frame has to be from the monthly, the weekly, and the daily. So now let's break it down. So when analyzing the market, we have what we call runs and trends. Runs. So what is a run? A run simply means a series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows on the higher time frame. So if the higher time frame is trending, higher highs, higher lows, higher highs, higher lows. Now this is for an uptrending situation. The higher high is a run. It is depicted by a run. The higher low is also a run. The next higher high is a run. The next higher low is a run, and so on and so forth on the higher time frame. And the same thing goes for what? The bearish example. What do I mean by that? On the bearish side, it is also series of runs. Lower low, lower high, lower low, lower high, lower low. On the higher time frame, these are series of runs. So now that we have established the fact that on the higher time frame, the market structures are called runs, but on the lower time frame, these same runs on the higher time frame are trends on the lower time frame. So what it simply means is that a run on the higher time frame is a trend on the lower time frame. A run on the higher time frame is a trend on the lower time frame. That statement to you seems casual, but it is not casual. If you think about it deeply, you understand it. A run on the higher time frame. So imagine on the monthly time frame, you had this type of run. What they are just trying to tell us is on the lower time frame, price will be trending. So on the daily time frame, you have a full-blown trend. Pullback to will be a trend. The next higher high that is forming will also be a trend. So it's as simple as that. A run on the higher time frame is what is a trend on the lower time frame. Just look at this. We have a run, 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 and run. But what do we have on the lower time frame? You can see the blue line that I denoted is a full-blown trend. The market is trending as well on the lower time frame. So the thick white line is what our higher time frame, which depicted our runs. But the blue line connoted what the trends of the market on the lower time frame. So these are series of runs on the higher time frame and a full-blown trend on the lower time frame. Once you understand this, that is all you need to know about multi-time frame analysis. That's all you need to know about multi-time frame analysis. So now let's go into the chart and look at what we are talking about. Now you can see this chart. We have what? Higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. Then a new higher high has been formed. But if you look at it carefully, if we go to, because this is daily time frame, now let's quickly go to the 4-hour time frame. On the 4-hour time frame, what do we have? You can see that internally, we have a full-blown trend. Let me make this smaller and change the column. So look at this. We have a full-blown trend on the 4-hour chart. This run was also a trend. Higher high, higher low, 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 higher high, higher low. The higher low failed to form and we had what? A change in trend. So we have what? Lower high, lower low, lower high, lower low. Again, higher high. What else? Higher low, failed, higher low, the lower low, lower high, lower low, lower high, lower low, lower high, lower low, failed lower high. We switched again, higher high, higher low, higher high, higher low, higher high, on and on and on. So now, do you guys understand what we are trying to say? The moment you understand this thing, you will never be caught on the wrong side of the market. Because some people usually see this trend on the lower time frame, and what do? They think a new trend is forming, thereby missing what the higher time frame is saying to them. If you are not paying attention, you are going to miss what the trend on the higher time frame is saying to you. So you have to pay attention for you to be able to get what the market is saying to you. But once you understand that statement, that a run on the higher time frame is a trend on the lower time frame, it is golden. That statement is golden. Once you just understand that statement on its own is golden. Just look at that. Look at the way the market has been moving magnificently. Now you can see that the market was trending after a series of runs on the higher time frame. The lower time frame was trending. But if you knew what the higher time frame perspective was saying to you, you will never be caught lacking in this market. So you can see we have what series of runs, and we have a full-blown trend on the lower time frame. Higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, lower low, lower 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 high, lower low. Sorry, higher high, higher low, higher high, higher low. On and on and on. A full-blown trend. It's as easy as that, a very simple concept, but you must be attentive. You must pay attention to what the market is saying to you. Now, what are we expecting? We're going to be expecting that downward trend again before we continue the overall run. So it's as simple as this. So what we have here is what we just saw on the live chat. It is as simple as that. It's as simple as that. So you need to understand that your runs can come from any time frame you decide to choose as your higher time frame, depending on the type of trader you are. If you're a day trader, your runs will come from where? The 4-hour chart. Then your trends will come from the 15-minute chart and below. If you are a scalper, your trend will come from probably, your runs will come from probably the 1-hour time frames, and your trends will come from the 5 minutes or the 1-minute time frame. So these are things you need to know about. In our next class, I'll be talking about the part 2 on this concept, where we'll be talking about change of character to know the exact moment a run is about to be finished, or the exact moment a run is about to start. So please stay tuned for the next video. Thank you.